Hello everybody, welcome to the core content video. In this one we will be showcasing a deeper dive into SMT. So getting started with the contents, we'll be showcasing two different things inside of this video. So the first piece of information is symmetrically timed SMTs, and the second piece of information is SMT gap alignment. So starting off with symmetrically timed SMTs, one way to determine the probability of an SMT is by viewing if the previous quarter the SMT reflects off of has a symmetrically timed high or low. And generally, SMTs that form based off of symmetrically timed highs or lows aren't required to have a second cracking correlation and immediately begin the run. So this is something that I introduced earlier this year, but this video should, put the nail in the coffin in terms of actually understanding how this works, because a lot of people misinterpreted this and made it a lot more confusing and a lot more difficult than what it really was. So now we will look at an example. So let's say we're coming into a day and we have London session and morning session, right? So we're working within Q2 and Q3 of the daily cycle. So London session's price action prints, right? And now we are coming into the New York morning session. So the absolute best case scenario is if London session's high, had the exact same high on all three of the assets. So let's say that once the London session closed, right, we looked on all three assets that we trade, being the S&P, the NASDAQ, and the Dow, and the high of London session on all three of these assets formed at the exact same time, in this example being 3:30. Now, if we come into the morning session, right, and the morning session plays out, and we see there is a sequential SMT between the London session and the morning session with the London session's high, this would be a symmetrically timed sequential SMT, which would be very high probability, right? These are the SMTs here that kick off the clean price runs. And like I mentioned earlier, they don't really require a second stage cracking correlation. And I'll say it one more time. Since the previous quarter that we're using, right, which would be the London session, the high formed at the exact same time on all three assets. So if a sequential SMT occurs at that high, it is a high probability SMT. Now, let's, flip the script a little bit. Let's say we are observing London session's price action, right? But asset one, or one asset that we're looking at, did one thing, and another asset we're looking at did a different thing, right? So let's say the asset on the left, which would be asset one, formed London session's high at 1:15 in the morning. Now let's say asset two, being the asset on the right, formed London session's high at 3:30 in the morning. All right, if an SMT were to occur at London session's high, it wouldn't hold the same weight in terms of probability as the previous SMT that we looked at, because it would be an unsymmetrically timed sequential SMT. So if you see an SMT occur with something that you're looking at on the screen, this is whenever you would need that second stage cracking correlation or that extra bit of confirmation to know that the daily cycle SMT you're looking at would work. Now that leads us into the next slide. So in terms of symmetrical and unsymmetrical timed highs and lows, the closer in proximity the previous quarter's high is, the higher the probability the SMT will be. The further away in proximity the previous quarter's high is, the lower the probability the SMT will be. And then, vice versa for the low, if it's the bullish SMT. So the further away in proximity the higher low of the previous quarter is, the lower the probability the SMT will be, if a cracking correlation or SMT occurs. But the closer it is, the higher the probability it is. Now you're not going to get, a 100% perfectly timed symmetrical SMT every single time. It doesn't form that frequently. but you can get a gauge in terms of probability just based off of proximity, right? If you look at the chart and you see that an SMT has occurred, but the high of the previous quarter on one asset formed way early in the quarter, and on another asset formed extremely late in the quarter, then you know that's an SMT that would have to have a lot of confirmation behind it. But if you're observing the chart and two assets have very closely timed highs in terms of the previous quarter's high or low, then you know it'll be a lot higher probability. All right, so now moving on with SMT gap alignment. So SMTs aren't required to form within gaps, but SMTs that use a gap as a foundation have heightened probability. So looking at the diagram, right, let's say price took its course on the higher time frame and left a higher time frame gap. That higher time frame gap can set up the foundation for a lower time frame setup or a lower time frame sequential SMT. The proper time frame alignment for these gaps and its corresponding SMT would be if you have a weekly time frame gap, then you'll look for a monthly cycle or weekly cycle sequential SMT inside of that gap. If you have a daily time frame gap, then you can use a weekly cycle or daily cycle sequential SMT. And if you have a 4-hour gap, then you can use the daily cycle or 90-minute cycle sequential SMT. Now, if you're wondering to yourself, okay, well, what gaps do I choose? How do I choose the correct gap? Well, think back to the previous core content videos on which time frames you're using intraday, the 15-minute, the 5-minute, and think about which cycle those time frames utilize, and then pair it with this right here. If you bring everything into the equation and you have a lot behind or backing a particular sequential SMT, you'll have a very, very, very high probability trade on your hands. And some of you probably just got, a light bulb moment from that. But we're just 4 videos in, and it's all starting to, come around and come full circle. But although this one was a little bit shorter, you now should have a very good understanding on symmetrically timed highs and lows and how to properly utilize it. And I would say about 95% of the confusion should be gone. So with that being said, hopefully you all found this one insightful. I'll speak with you all again soon. Good luck and good trading.